Hi everyone. So today we are continuing with Model 3 Unit 1 and we are still going to talk about the gross domestic product, that is the GDP. And if you remember, then from the last video we had defined GDP as the total value of all final goods and services that are produced domestically within the geographic boundaries of a country during a given accounting period. Now that accounting period is usually 1 year. Then we went on to look at the 4-sector circular flow model, and the reason we were looking at the circular flow model is we said that that model would help us to understand the flow of money in the economy, and it would also help us to understand how the accounting of GDP or the gross domestic product is done in the economy. Now in United States, the accounting for the gross domestic product is done by the Bureau of Economic Analysis, that is the BEA. So they keep track of the GDP. So now if you look at the definition of GDP, then GDP is basically looking at the value of all final goods and services produced in the economy. Now today we are going to start with talking about the different ways to measure GDP. So we are going to look at measuring GDP. The first and foremost method for measuring the GDP, it is called the spending method or expenditure method. So the justification behind this method, the theoretical justification is that if you are looking at the value of all final goods and services produced, then you should be somehow be able to get to that value. You should be able to numerically track that value if you look at all the spending that has been made on all goods and services that were produced in this country. So for example, in a very simplified example, if I tell you, for example, let's say I ask you how much did you spend on shirts, and you say $10, and I say, okay, how much did you spend on groceries this month? You say $100. How much did you spend on rent? You say $500. And how much did you spend on education? You say another $100. Okay, and let's say that those are the only 4 items that were produced or that were consumed during this accounting year. So during this year you have spent on education, grocery, rent, and you have bought some shirts. So those are the only 4 heads that were produced and consumed during this year. So if I have to find out the value of all the production during this year, then I could just add up your spending for this year and I would be able to track that value. Right? Because what is basically the value of this shirt? The value of this shirt is basically 1 times the price of this shirt. If I had to find out the value of 3 such shirts, then I would do 3 times the price of this shirt. So now someone must have spent on this shirt, right? In this case it is me. I buy myself clothes, so it is my spending. So if I just go to my bank account and look at my credit card statement, I will be able to see how much I spent on buying the shirts, and that will exactly be the value of the shirts. So what I'm trying to get at is you will be able to see what is the value of the goods produced and consumed in an economy if you're able to track the entire spending of the economy on those goods and services. Now if you remember, there are 4 sectors of the economy, as we discussed in the circular flow model, who are spending on goods and services. So the government is spending on goods and services, and if you remember, that spending was called capital G. It is the government spending on goods and services. If you do not remember this, I advise you to go back to the circular flow model video and refresh your memory. So the government spending on goods and services is capital G. Then there are the households of the economy that are spending on goods and services. Their spending is known as the consumption spending, which is capital C. Then there are the business firms in the economy which are also spending on goods and services. Their spending is known as investment spending, which is denoted by capital I. And finally, there is rest of the world or the foreign sector that is spending on goods and services, and their spending, the spending that the foreigners are making on the goods and services is basically the exports of USA, what USA is exporting to those countries, right? So that means if I add up the spending, if I add up all these spendings, then the GDP of the country should be equal to C plus I plus G plus X. Okay, now there is a catch here. Okay, so there is a small problem here. Please note that this, the capital C, the capital I and the capital G, that is the spending of the other sectors of the economy, not only includes the goods that were produced in this economy, but it also includes the goods that came from other places to this country. So for example, what I'm trying to say is, if I walk into a store in United States, I can buy something that is made in USA. I'm also buying something that is made in some other country, for example made in India or made in Vietnam or made in Bolivia or made in Philippines, right? We are all doing that. Similarly, sitting in Bolivia, you not only buy the goods that are made in Bolivia, but you also buy goods that could be made in USA or Mexico or Chile or Peru or anywhere else, right? So the idea is that we are not only spending, the households are not only spending on goods that are produced within the boundaries of the country, the geographic boundaries of the country, but they are also spending on goods that were imported into your country from other places. And the same is true for business firms and for the government. The firms and the government, they are also buying some goods that are not made in USA, but they are coming into USA from some other country. That means the imported goods, right? But remember, in GDP, according to the definition of GDP, we only want to track the value of the goods that were produced within the borders, the geographic boundaries of this country. That means from this equation we need to subtract the value of the imports, where imports is denoted by capital M, if you remember from your circular flow diagram. So here C stands for consumption spending of households. So this is the household expenditure. I stands for investment spending. G stands for government spending. Expenditure and spending mean the same thing. X stands for exports and M stands for imports. Now why are exports included? Because remember, exports are the goods that are made in USA but they were consumed outside USA. So they went from USA to the other countries and people of those countries bought it. So it is still included because it was made in USA, and we are worried about the goods that are made in USA. Now this part, the X and M, if we look at X minus M, then that is known as NX or net exports. The X minus M, the difference between exports and imports of a country, is also known as net exports, and it is denoted as NX. So basically this part, the X minus M part, is my NX. So I could say by the spending method, the GDP formula is C plus I plus G plus NX, and this GDP is usually denoted by a capital Y. So capital Y is equal to C plus I plus G plus NX, and that is the formula for GDP by the spending method, and that is how you would track the GDP of a country. Now besides the spending method, there is a second method for tracking the GDP, and that is known as the income method. So now the intuition behind this method is whatever is spent, whatever money gets spent, that money must have been earned somewhere. So whether you add up the spending or you add up the income, it should basically give you the same number. It should end up giving you the same number, whether you look at the spending or the earning. So the idea is, if I spend $10 on buying this shirt, then I must have earned the $10 somewhere. So if you broaden the picture, and if you look at the whole economy, then for the whole economy, whatever money is spent in the economy must have been earned somewhere. Those earnings must have come from somewhere, because money does not come out of thin air. It needs to be earned, right? So by the income method, we say that we can get to the GDP by adding up the income of the people in the economy, and that income could be in the form of wages or rent or profits or any type of interest income or any kind of dividends earned on financial products. So all income that you have has to be in one of those categories. So if you add up the income of the people, whichever category it may be, then you should be able to get to the GDP. That is the income method for calculation of GDP. And like I told you, the logic is that whatever is spent in the economy must have been earned, and any earnings that people in the economy have must take one of those forms. It's either earned in the form of wages or in the form of rent or in the form of profit or interest income or dividends on some financial products that you may own. Now the last and final method, which is a little tedious method, which is a little abstract method, but nevertheless it is important. The third method is the value added method. Value added method, sometimes abbreviated as VAM. According to the value added method, we add the value added at every stage of production, and this method is particularly useful because once again, if you go back to the definition of GDP, the GDP says that you only include the value of all final goods and services. So that word final is very important, but you know that to make a final product you need several intermediate products or inputs, right? For example, if your final product is a loaf of bread, then you need lot of intermediate resources. For example, you need the baking equipments, you possibly need a baking chef, you possibly need flour, you need baking soda, maybe you need some essences, and before that you need wheat which needs to be bought from the farmer. That wheat needs to be ground into making wheat flour and all of that, right? So that means there are various intermediate stages in the production of a final commodity, and at those intermediate stages you are using these intermediate goods. So now you hear about two kind of goods, final goods and intermediate goods. Intermediate goods are nothing but the inputs, and final good is nothing but the output. Okay, so in GDP we are only worried about the final output, we only want to include the final output. Okay, so the value added method basically helps you to take into account only the value of the final good and leave out the intermediate goods and leave out the value of the inputs. So in the value added method, you have value added, VA is basically the selling price of the good minus the cost of inputs, that is value added. Okay, so the definition or the formula for value added is selling price minus the cost of whatever inputs has been used. Now according to the value added method, you add this value added at every stage of production, at every stage in the value chain of a commodity. For example, in my bread example, if bread is your final commodity, then there are several stages before that bread is made. For example, the farmer will sow the seeds and he will yield the crops, he will produce the crops, wheat or corn or whatever has been used to make the bread, let's say wheat. Now the farmer's final product is wheat, but he has used some inputs like seeds and fertilizers to produce that wheat, right? So we can calculate the farmer's value added by finding out the selling price of his wheat minus the cost of the inputs, the fertilizer, seeds, etc. that he used. Now the next stage is the miller. The miller buys the wheat from the farmer, so the miller's input is the wheat, and the miller produces the flour. He grinds it in whatever machines and he produces the flour. So the miller's value added would be the selling price of the flour minus the cost of his inputs, which is basically the machines he used for grinding the wheat. Now from the miller, the next stage is the baker. So the baker bakes the bread. So the baker's final commodity is the bread, but the wheat that he buys from the wheat flour that he buys from the miller, that is his input, right? So that means at every stage of production, you are able to find out a value added for that particular stage of production. And if you add up all the value added at every stage of production, then you will be able to get to the value of the final commodity very easily. And this method is particularly useful so that you can avoid the problem of double counting, and you can avoid the problem of counting in the value of the intermediate goods, which is not desired for the GDP. So that means we have come to now 3 methods for measuring the GDP. Number 1 being the most important method, which is given by this formula where you add up the spending of all sectors of the economy. Next, the income method, and finally the value added method. Now in the next video, we are going to reflect on the definition of GDP, and we are going to talk about what are the things that get excluded from the GDP and what is really included in GDP.